Gold prices hit another record high this year, and you've probably seen someone in your social feed bragging about their gold bar gains. But here's what you don't know. While you're calculating those modest returns, central banks around the world are using gold to rewrite the rules of money itself. And the main player in this game is China. In just the first 7 months of 2025, the Shanghai Gold Exchange processed 29 trillion yuan in transactions, a staggering 49% jump year over year. China's central bank keeps adding to its gold reserves. BRICS expanded from 5 nations to 11, now representing 30% of global GDP. So why is the entire world racing to stockpile gold? And how will this invisible currency war hit your wallet? The Shanghai Gold Exchange recorded 29.05 trillion yuan in trading volume for the first 7 months of this year, surging 49.24% compared to last year. That number alone is striking, but what it represents is even more profound. China is using transaction volume to seize global pricing power over gold. To understand the depth of this revolution, you need to see a critical comparison. The Shanghai Gold Exchange now handles a daily average trading volume exceeding $145 billion. Meanwhile, US Treasury bonds with 7 to 10-year maturities trade around $143 billion daily, and bonds with maturities over 20 years barely reach $72 billion. What this means is simple. The liquidity depth of the Shanghai gold market has now surpassed the core asset underpinning dollar dominance, which is US Treasury debt. Why does liquidity matter so much? Because it determines whether a market can handle international settlement functions. For the past several decades, the dollar dominated global finance, not just because of American military power, but because the treasury market provided bottomless liquidity. Central banks needed somewhere to park foreign exchange reserves. Sovereign wealth funds needed a safe investment channel. Multinational corporations needed a stable settlement instrument. The treasury market could provide all of these. That liquidity advantage became the most fortified moat protecting dollar hegemony. But now, the Shanghai Gold Exchange is breaching that moat. When trading volume grows large enough and liquidity runs deep enough, gold stops being just a safe haven commodity. It transforms into a settlement tool that can compete with the dollar on equal footing. That's why Wall Street isn't really worried about gold prices rising. What actually makes them nervous is the explosive growth in Shanghai's trading volume. This liquidity revolution keeps accelerating. Chinese gold ETF holdings exploded by 86.66% over the past year, with ordinary investors voting with real money. Against a backdrop of sluggish real estate and volatile stock markets, capital has flooded into gold markets, creating a positive feedback loop. The stronger the demand, the better the liquidity. The better the liquidity, the stronger gold's monetary properties. The stronger those monetary properties, the more capital flows in. The deeper logic here involves the transfer of pricing power. London and New York used to dictate international gold prices, with Asia merely accepting whatever price they set. But when Shanghai's trading volume dominates globally, the center of price discovery inevitably shifts east. Whoever controls the market with the deepest liquidity controls pricing power, and pricing power is the true source of monetary hegemony. The strategic intent behind this liquidity revolution has become crystal clear. China is transforming gold from what the West defines as a bulk commodity into an Eastern-dominated monetary instrument. But liquidity is just the infrastructure. For gold to truly function as money, it needs physical reserves as backing. And China's moves on the reserve front show even more strategic depth than the growth in trading volume. If trading volume represents a tactical breakthrough, then reserve accumulation represents strategic positioning. From 2024 to 2025, China's central bank made continuous moves on gold reserves, revealing a long-term strategic objective: fill that 9 percentage point allocation gap. The data shows China's gold reserves have surpassed 2,290 tons, ranking 6th globally. But the key isn't the absolute quantity, it's the relative proportion. Gold represents only 5.96% of China's foreign exchange reserves, far below the global average of 50%. This seemingly simple numerical gap masks what could be a decade-long strategic adjustment. Run the numbers, and the full picture becomes clear. China holds foreign exchange reserves totaling $3.2 trillion. To reach the global average allocation ratio, China would need to acquire roughly another 3,000 tons of gold. Even at the current relatively aggressive pace of accumulation, achieving this goal will take years. This isn't short-term speculation. This is systematic asset reallocation. The core driving force behind this strategic accumulation comes from a reassessment of dollar system risk. When Russia's $300 billion in foreign exchange reserves got frozen, it shattered a consensus that had lasted decades. dollar assets aren't absolutely safe. When reserve assets can be frozen by political decisions, when the SWIFT system can be weaponized for sanctions, central banks worldwide must rethink a fundamental question: what assets truly belong to you? Gold provides the answer. It's the only asset that cannot be turned off. You can freeze bank accounts, you can ban access to payment systems, but you cannot make physical gold in a vault disappear. This inalienable physical property has become the scarcest form of security margin in an era of rising geopolitical risks. An even deeper change happened at the regulatory level. Basel III already classified gold as a Tier 1 asset, meaning banks can value it at 100%, the same as cash. This seemingly technical regulatory adjustment actually changed gold's position on central bank balance sheets. Holding gold used to dilute liquidity ratios. Now it actually enhances asset quality. This cleared institutional obstacles for central banks to massively increase gold holdings. So China's continuous accumulation is essentially hedging against systemic risk in the dollar system. The goal isn't to push the ratio to 15% in the short term, but to gradually build a more balanced reserve structure over the next decade. In this structure, dollar assets and gold complement each other. Dollars provide liquidity and returns. Gold provides safety and hedging. But a deeper contradiction emerges here. Even if China stockpiles enough gold, if it just sits quietly in vaults, what makes it different from rocks? For gold to truly function as money, it must circulate, settle transactions, and be trusted by other nations. This requires a collaborative mechanism that transcends any single country, and the expansion of BRICS exists precisely to build such a mechanism. While China pushes its gold reserve ratio from 6% toward 15%, another more ambitious project proceeds in parallel. Make that gold flow freely within an 11-nation alliance. This is the true significance of BRICS expansion. It's not simply a country club adding members. It's building a trust network independent of the dollar. BRICS grew from 5 nations to 11, reaching a critical mass that changes everything. The population represents 42% of the global total. GDP accounts for 30%. Trade volume hits 20%. This scale means BRICS now has the economic foundation to establish an independent monetary system. But economic size doesn't guarantee coordinated operation. The real challenge becomes this: how do 11 nations with vastly different levels of economic development, political systems, and monetary policies trust each other? The traditional solution involves creating a unified currency, like the euro. But BRICS member nations differ too dramatically for a unified currency to work. China proposed a more elegant solution. Don't demand trust in any particular nation's currency. Just demand trust in gold itself. This is the design logic behind the gold corridor. The Shanghai Gold Exchange linked up with vaults in Hong Kong, the Middle East, and Africa to establish an interconnected physical network. Each nation's gold stays in vaults within its own sovereign territory, but all vaults connect to the same tracking system, which records in real time every bar's serial number, purity, ownership, and transfer history. The genius of this mechanism lies in how it transforms the problem of trusting a particular country into the problem of verifying physical existence. India doesn't need to trust China to properly safeguard its gold, because the gold sits right there in a New Delhi vault where India's central bank can verify it any time. But through system interconnection, that gold can serve as collateral for trade settlement within BRICS. From a financial engineering perspective, this is a decentralized trust protocol. It borrows blockchain's underlying logic, using cryptography and distributed ledgers to establish trust, but replaces virtual tokens with physical gold and distributed nodes with physical vaults. You could call this a physical blockchain, using the most ancient trust medium, which is gold, to achieve the most cutting-edge trust mechanism, which is decentralized verification. With this system as support, the BRICS Pay cross-border payment system began operating. Member nations settle daily trade using local currencies, but if trade imbalances emerge, they can use gold for final clearing. The data shows the proportion of local currency settlement within BRICS has climbed from 65% 2 years ago to nearly 75% now, with plans to hit 90% by 20. This means trillions of dollars in annual trade volume is being pulled out of the dollar system. The strategic intent behind this trust engineering project has become unmistakable. Replace institutional trust with physical trust. Replace political promises with physical verification. In this system, you don't need to trust any hegemonic nation's monetary policy. You just need to trust gold's physical scarcity. This poses a fundamental challenge to the dollar system. The dollar's credit rests on Federal Reserve promises, while gold's credit rests on the laws of physics. But even with the trust problem solved, a more troublesome obstacle remains. Can gold be used for financing like treasury bonds? If an African nation wants to build a port, can it borrow money in international markets using gold? This touches the final shackle the West has placed on gold. It's not a high-quality liquid asset. When China built liquidity with 29 trillion yuan in trading volume, strengthened reserves through continuous accumulation, and established trust via an 11-nation alliance, all the conditions for gold monetization seemed ready. But the Western financial system erected one final defensive line. Gold is not HQLA, not a high-quality liquid asset. This defensive line appears to be a technical regulatory classification, but it's actually the core bastion of monetary hegemony. The power to define HQLA sits with the Basel Committee on Banking Supervision, which Western nations dominate. Currently, globally recognized HQLAs are mainly government bonds, with US Treasury bonds holding absolute dominance. Gold's current status is awkward. It's already a Tier 1 asset, meaning banks can value it at 100%, the same as cash. But when it comes to collateralized financing, gold can only be borrowed against at 80% of book value, while US Treasuries go for 95%. That 15 percentage point gap directly determines why global financial institutions prioritize treasury holdings over gold. The World Gold Council used detailed data to prove gold already meets all HQLA standards. Volatility matches long-term treasuries. Bid-ask spreads are narrower. Daily trading volume runs higher. Yet the European Union postponed key Basel III reforms until next year. The United Kingdom pushed them to the year after, and the United States won't even provide a timeline. Why the delays? Because once gold enters HQLA, global asset allocation will undergo violent adjustments. Institutional estimates suggest central banks, sovereign wealth funds, and pension funds might increase gold allocations by roughly $2 trillion. Where does that $2 trillion come from? It can only be pulled from the Treasury market. The Treasury market cannot absorb that kind of shock. US government debt stands at $35 trillion, with annual deficits exceeding $2 trillion, all dependent on global investors buying in. If demand drops, yields inevitably rise. Government interest burdens grow heavier, fiscal pressures intensify, potentially triggering a debt crisis. So the West uses delay tactics to defend Treasury bonds' monopoly on HQLA status. This is a battle over definitional power. The West controls the power to define HQLA, which means controlling what assets can be used for international financing. Keeping gold excluded from HQLA prevents it from exercising full monetary functions within the Western-dominated financial system. This is the soft blockade the West imposed on gold. They don't prohibit you from holding it, but they restrict you from using it. But China and BRICS have developed a clear response strategy. Don't wait for your approval. Build a parallel system. Within BRICS, gold is HQLA. Member nations can use gold as collateral to obtain local currency loans from the New Development Bank for infrastructure construction. This system doesn't need Basel Accord certification. Member nation recognition suffices. This marks the global financial system entering an unprecedented phase. Two sets of HQLA standards exist simultaneously. The Western-defined HQLA centers on treasury bonds. The Eastern-built HQLA centers on gold. Two systems operate separately, competing with each other. This isn't a technical regulatory disagreement. This is fundamental confrontation over monetary hegemony. When we assemble all the puzzle pieces, the full picture of this currency war comes into focus. China built the liquidity foundation with 29 trillion yuan in trading volume, strengthened physical reserves through strategic accumulation, constructed a trust network via the BRICS alliance with the ultimate goal of making gold function as international money again, without depending on Western HQLA certification. The essence of this war pits two trust logics against each other. The Western system rests on institutional trust. You trust the Federal Reserve's monetary policy. You trust the US government's debt repayment capacity. You trust the American legal system to protect creditors. The Eastern system rests on physical trust. Gold's value needs no government endorsement. Its scarcity is determined by physical laws that no regime can alter. Markets are already voting with their feet. Gold prices broke historical highs multiple times in 20. Global central banks purchased over 1,000 tons annually for 3 consecutive years. These trends validate the return of physical trust. Meanwhile, Bitcoin is also surging. This most cutting-edge digital asset and this most ancient physical currency, with completely opposite logics, are simultaneously attracting safe haven capital, showing that market confidence in traditional fiat currencies is collapsing. Goldman Sachs raised its gold price target for next year to $3,300 per ounce. Some institutions predict prices could double within 5 years. Speculation cannot explain this. This is structural revaluation. When BRICS rebuilds trade systems using gold, when Shanghai's liquidity can support international settlement, when more and more nations upgrade gold from reserve asset to settlement instrument, gold completes its return from commodity to currency. This war won't have winners and losers in the traditional sense. The more likely outcome is two systems coexisting long-term. The West continues maintaining the dollar plus Treasury plus SWIFT system. The East builds the yuan plus gold plus BRICS pay system. Global trade and financial activities split between the two systems, with each nation choosing which system to use based on its own interests. For ordinary people, this might be the first time in history that genuine choice over currency has returned to our hands. Before, you could only passively accept government-issued fiat currency. Now you can allocate gold to hedge fiat currency risk. You can hold digital currencies for efficiency. You can flexibly allocate across different systems. Competition between two systems will force each to improve. The ultimate beneficiaries are ordinary people with the power to choose.